Welcome to The Explainer. Today we're jumping right in to break down two terms that can really trip up investors: rights issues and bonus shares. We're going to cover what they are, what they actually mean for your money, and most importantly, what you should do when one pops up for a stock you own. So, picture this. You check your portfolio, and there's a notification. One of your favorite stocks just announced a rights issue. What on earth is that? Do you need to do something? Or can you just ignore it? Let's clear up that confusion right here, right now. Okay, so before we can even talk about rights and bonus shares, we got to start with the bigger picture. They both fall under this umbrella called corporate actions. Just think of these as major events that a company kicks off, events that have a real direct impact on its shares and, yeah, on you. So a corporate action isn't just some press release or a minor update. Nope. It's a significant event that actually changes the company's stock in a material way. It's something that often requires you, the shareholder, to make a decision, and it can absolutely affect the value of what you own. All right, let's get to the heart of it. Rights issues versus bonus shares. Now listen up, because while they both mean new shares are being created, they are fundamentally different beasts. Getting this distinction right is probably the most important thing you'll take away from this. Here it is, the simplest way to think about it. With a rights issue, you are being invited to buy more shares. You have to pay for them, but you get them at a nice discount. A bonus issue, on the other hand, is basically a gift. The company gives you new shares for free. So one costs you money, the other one doesn't. That's the core difference. Let's dig into rights issues for a sec. The company is basically turning to its loyal owners, that's you, and saying, hey, we need to raise some cash and we want to give you the very first shot to invest more in us at a special discounted price. That discount is the whole reason you'd even consider it. And these things can be absolutely massive. Just look at this number. In 2020, Reliance Industries raised over 53,000 crore rupees through just one rights issue. This wasn't some small change, it was one of the biggest capital raises in Indian corporate history, all to fuel a huge strategic pivot. So a rights issue is about raising cash. A bonus issue? It's a totally different animal. And honestly, the best way to get it is to think about pizza. Imagine you have a pizza. A bonus issue is just like taking that same pizza and cutting it into more slices. You end up with more pieces, sure, but the total amount of pizza you have hasn't changed one bit. Let's put some quick numbers on this to see how it works. Let's say, before the bonus, you own one share of a company and it's trading at 100 rupees. Simple enough, right? Your total holding is worth 100 rupees. Then, boom, the company announces a one-for-one bonus issue. You get an extra share for free. So now you have two shares. But, and this is the key part, watch the price. The market immediately cuts it in half. So your two shares are now worth 50 rupees each. Your total value? Still 100 rupees. More slices? Same pizza. Okay, so we know what these things are, but that's only half the battle. The real question is, what should you actually do about it? When a rights issue lands in your lap, you need a way to think it through and make a smart call. Here's a simple 3-point checklist you can use every single time. First, the fundamentals. Do you still believe in this company enough to own more of it? Second, and this is crucial, why do they need the money? Is it for exciting growth, or are they just trying to plug a hole in a sinking ship? And third, the valuation. Is that discount they're offering really a good deal? You know, that second point, why they need the cash, is so important. A company raising money to build a new factory is a totally different story from one raising money just to pay the bills. In that huge Reliance case, the reason was crystal clear. They wanted to pay down debt and pour money into their digital business. That's a story an investor can get behind. So let's put it all together in this little decision matrix. Think of it as your personal cheat sheet. If you have high conviction in the company and the discount is attractive, well, participating fully makes a ton of sense. But what if your conviction is low? Then even a great discount might not be worth it. You could sell your rights to someone else, or maybe this is a signal to rethink the investment entirely. Knowing what to do is great, but just as important is knowing what not to do. There are some really common traps that people fall into with these things, so let's shine a light on them so you can avoid making a costly mistake. When it comes to rights issues, please, the biggest mistake you can make is just doing nothing. Those rights have actual value. Letting them expire worthless is literally like finding a gift card and just throwing it in the trash. Also, don't just participate automatically without thinking. And you have to be obsessed with the deadlines. They don't bend. Now, for bonus shares, the mistakes are usually based on myths. The number one myth is the free money myth. Come on, remember the pizza? No new value is being created. You're not getting richer. And don't just assume a bonus means the company's doing great. Sometimes it's just a trick to make an expensive stock look cheaper and more attractive. So, we've covered the basics. We've covered the mistakes to avoid. Now, let's just level up for a minute. Because for a really savvy investor, these corporate actions aren't just annoying administrative tasks. They can actually be strategic opportunities. Here's how you should really think about it. A rights issue, especially, is a test. The company is looking you in the eye and asking, do you still believe in us, enough to put more skin in the game? It forces you to reevaluate why you own the stock in the first place, which is always a good thing. It's not a footnote, it's a headline. And that really brings us to the final question you should ask yourself. The next time you see one of these announcements, don't just see it as a hassle. See it for what it is, a direct question from the company to you. So are you just a passive passenger along for the ride, or are you an active co-pilot of your investment strategy? How you answer that could make all the difference.